Adam Neumann destroyed $40 billion of investor money, was found to have invented his company's financial metrics, was forced to resign as CEO, and left with a $1.7 billion exit package. The 2,400 employees he laid off received standard severance. The company he built filed for bankruptcy 4 years later. Neumann launched his next startup within months, raised $350 million from a top Silicon Valley firm, and appeared on the cover of Forbes. If this sounds like the system malfunctioned, it didn't. This is how the system works when you know how to use it. And Adam Neumann knew exactly how to use it. To understand the fall, you have to understand the peak. January 2019. WeWork is worth $47 billion. More than any other private startup in the United States. More than Airbnb. More than Lyft. The man behind it is Adam Neumann, an Israeli entrepreneur who reportedly went barefoot in boardrooms, quoted Kabbalah to pension fund managers, and once told a roomful of investors that his company would live forever. He surfed before meetings. He smoked marijuana on private jets. He spoke about WeWork not as a business, but as a consciousness, a physical social network for the future of work. And it worked. Not the business, the performance. The world's most sophisticated investors handed him money faster than he could spend it. Almost. Strip away the mysticism and the barefoot boardroom theatrics, and WeWork's business model fits on a napkin. They signed long-term leases on office buildings, typically 10 to 15 years. Then they subdivided those spaces and rented desks to freelancers, startups, and small companies on month-to-month contracts. Long-term obligations. Short-term income. This arbitrage had existed in commercial real estate for decades. Similar models had existed profitably in commercial real estate for decades. But Neumann didn't call it real estate. He called it technology. He called it community. He filed WeWork's IPO under We Company, a brand name so abstract it suggested the company was less a business than a way of being. By 2019, they had 528 locations across 111 cities. Their long-term lease obligations totaled $47 billion, the same number as their valuation. That was not a coincidence. That was the whole problem. The man who made all of this possible wasn't on Wall Street. He was in Tokyo. Masayoshi Son runs SoftBank, and in 2016 he raised the largest technology investment fund in human history, $100 billion, backed heavily by Saudi Arabia's sovereign wealth fund. Son had a theory. The world was approaching a technological singularity, and the companies that would define the next century needed capital at a scale no one had attempted before. In 2017, Son met Adam Neumann. The meeting lasted 12 minutes. Son committed $4.4 billion. He later described his philosophy as backing companies that make him feel crazy, companies whose ambition is so outsized that rational analysis feels beside the point. By early 2019, SoftBank had poured $10.65 billion into WeWork, the single largest bet in the Vision Fund's history. When the world's biggest fund backs you unconditionally, everyone else falls in line. That is how $47 billion happens. SoftBank's billions made WeWork untouchable, or so it seemed. But there was a second layer of validation that no one discussed openly. JPMorgan Chase was selected to underwrite WeWork's IPO, which meant JPMorgan's reputation was directly tied to the offering's success. That alone was a conflict of interest. Jamie Dimon, JPMorgan's CEO, went further. He personally arranged a $500 million loan to Adam Neumann, secured against Neumann's WeWork shares. Think carefully about what that means. The bank responsible for selling WeWork stock to the public was simultaneously lending $500 million to the man whose net worth depended on that stock being overvalued. If the IPO succeeded, everyone got rich. If it failed, Dimon's bank held collateral in a company it had just helped destroy. This was the ecosystem WeWork operated in. The normal rules had been suspended, replaced by a closed loop of mutual interest that no one inside had any incentive to break. While the money flowed in, Neumann was flowing it back out. Before the IPO, He sold or borrowed against $700 million of his personal WeWork shares, converting paper wealth into real assets while telling employees they were on the verge of changing the world. He purchased 5 private jets. He bought real estate in New York, the Hamptons, California, and the English countryside. He invested in a wave pool company. He invested in a school for his children based on his spiritual beliefs. He even trademarked the word "we" personally, then sold that trademark back to his own company for $5.9 million. A self-dealing transaction so brazen that WeWork's own advisors forced him to return the money once it appeared in the S1 for the world to read. He returned it. It barely made the news. There was a bigger number buried deeper in that same document. An S1 filing is the document a company submits to the SEC before going public. It is reviewed by federal regulators. Executives sign it under penalty of criminal prosecution. You cannot make material misrepresentations in an S1. When WeWork's prospectus was published on August 14, 2019, analysts read it the way a surgeon reads a scan, looking for what was wrong. The headline number was not hard to find. In 2018, WeWork had generated $1.8 billion in revenue. In the same year, it had lost $1.9 billion. Losing more than $1 for every dollar earned is not a growth stage problem. It is a structural one. A business that scales that model doesn't approach profitability. It approaches a larger version of the same whole. The analysts who had been privately skeptical for years finally had a public document to point at. But the losses weren't even the most alarming thing they found. Buried in the prospectus was a new financial metric. Neumann's team had invented it specifically for this document. They called it community-adjusted EBITDA. EBITDA, earnings before interest, taxes, depreciation, and amortization, is already a generous measure of profitability that strips out significant costs. Community-adjusted EBITDA stripped out more. It excluded rent. It excluded interest. It excluded taxes. It excluded depreciation. It excluded amortization. And it excluded stock-based compensation. In other words, it excluded nearly every cost WeWork actually had. Under this invented metric, WeWork appeared almost profitable. No accounting standard recognized it. No regulator had blessed it. Neumann had simply decided that a company which loses money on every transaction can look profitable, if you agree not to count the losing. Financial analysts described it as among the most aggressive accounting maneuvers they had encountered in a major public offering. If the invented accounting metric was the financial scandal inside the S1, the governance section was the personal one. The document disclosed that Neumann's wife, Rebecca, had been granted authority to select his successor as CEO. Not the board of directors, not the shareholders, but his wife. WeWork's S1 used the word community 150 times and the word we 169 times. Could not describe a single credible path to profitability. What had been sold to the world as a revolutionary technology company with a visionary founder was, on paper, a family business with a governance structure that would have embarrassed a medieval fiefdom. The institutional investors the IPO needed, the pension funds, the university endowments, the sovereign wealth managers, read those pages and made their decision quietly. They would not participate. The market's verdict was swift and mathematical. Within days of the S1 filing, analysts began publishing target valuations. Not $47 billion, not $30 billion, not $20 billion. Numbers in the single-digit billions appeared alongside phrases like uninvestable and governance red flags. By mid-September, 35 days after the S1 dropped, WeWork's estimated IPO value had collapsed below $8 billion. A $39 billion evaporation in 5 weeks. On September 30, 2019, WeWork officially pulled the IPO. The offering that was supposed to be the defining tech listing of the year simply ceased to exist. The company that had been worth more than Boeing in January had failed to attract enough buyers at any price. But the company itself still existed. It still had 528 offices, 12,500 employees, and lease obligations stretching 15 years into the future. Something had to happen next. On September 24, 2019, Adam Neumann was forced out as CEO of the company he had founded. The board had assembled enough legal and financial leverage to make his removal unavoidable. He had destroyed WeWork's path to public markets. He had personally extracted $700 million while employees held worthless equity. He had created governance structures that made the company uninvestable. Any rational accounting of his tenure ended in a single word: fired. The exit package he received was $1.7 billion. $185 million of that was described in official documents as a consulting fee paid to the man being removed for cause to a company he had just helped destroy. Neumann signed the paperwork and flew home on one of his 5 jets. He was 41 years old and now had more money than he could spend. The thousands of employees he left behind did not. October 2019. SoftBank had no good options. Walking away from WeWork meant writing off $10.65 billion, a loss so large it would destabilize the Vision Fund and humiliate Masayoshi Son in front of the Saudi sovereign wealth fund that had backed him. So SoftBank did the only thing available to an investor too deep to quit. They put in more money, a $9.5 billion rescue package. In exchange, they took 80% ownership of a company now worth a fraction of what they had paid. WeWork, meanwhile, announced layoffs. 2,400 people, nearly 20% of the global workforce, lost their jobs. These were the employees who had believed in the mission, who had taken equity instead of market-rate salaries, who had decorated their desks under slogans about elevating the world's consciousness. They were walked out with standard severance. Adam Neumann, who had designed the structure that made all of this possible, received $1.7 billion. The math was clear. It simply was not the math anyone had been promised. In November 2019, Masayoshi Son stood before cameras at SoftBank's quarterly earnings presentation. The Vision Fund had just reported an $8.9 billion operating loss, the worst quarter in SoftBank's history, driven primarily by WeWork. Son is not a man given to public contrition. He has bet wrong before and said nothing. This time he spoke. "My investment in WeWork was foolish," he said. "It was a mistake." The admission was rare for a man of his stature and influence. That admission, from one of the world's most powerful investors, was the official close of the WeWork era. The fund designed to define the future of technology had made its single largest bet on a company that rented desks. SoftBank's largest tech investment wasn't a chip company, or an AI lab, or a quantum computing startup. It was a real estate business with a yoga mat and a mission statement. WeWork staggered forward for 4 more years. New management, cost cuts, a SPAC merger in 2021 that briefly gave it a public listing. None of it changed the underlying reality. A company with $47 billion in long-term lease obligations that could not reliably fill its offices was not a business that could survive indefinitely. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection. Its market capitalization at the moment of filing was approximately $44 million. $44 million, down from $47 billion at its peak. A 99.9% destruction of value. The company whose prospectus had promised to elevate the world's consciousness had, in the end, been unable to pay its landlords. The offices that had once been described as the physical manifestation of a new kind of human connection were handed back, one by one, to the building owners who had been waiting. Adam Neumann did not disappear. Within months of his firing, he launched a new company called Flow, a residential real estate startup with, once again, a mission statement about reimagining how people live. Andreessen Horowitz, one of Silicon Valley's most prestigious venture firms, invested $350 million. Forbes put Neumann on its cover with the headline asking whether he deserved a second chance. The investors who lost billions in WeWork received write-downs and subpoenas. The man who designed the system that produced those losses received new capital and a magazine profile. This is not unusual. In the world Neumann operated in, charisma and the willingness to say large numbers with conviction are treated as evidence of vision. The specific outcomes those numbers produced are considered beside the point. The system that funded WeWork did not malfunction. It functioned exactly as designed. Adam Neumann simply understood the design better than anyone else in the room. WeWork is not a story about one con man who fooled the system. It is a story about what the system looks like when enough money, enough confidence, and enough mutual interest occupy the same room for long enough that no one asks the obvious question. Does this business actually make sense? SoftBank, JPMorgan, Harvard's endowment, dozens of institutional investors who employ the most analytically rigorous people on earth. They all looked at a real estate company that was losing $2 for every dollar it earned, and they saw a $47 billion technology company. The lesson is not that Adam Neumann was exceptional. It is that the incentive structures around him made pretending to be exceptional more profitable than the alternative. The story of WeWork is not over. It will happen again with a different name, a different mission statement, and a different man standing barefoot in a boardroom. If Rise and Ruin covers the stories that matter before everyone else moves on, subscribe. There are more coming.